I think, you know, UiPath is coiled up enough that if it becomes clear to the market that growth is actually going to be accelerating a ton, then yeah, Wall Street's not going to ignore free money pretty much. So once the narrative changes, it's crazy how re-rated UiPath could become. So I'm hoping that this quarter could be the catalyst for the re-rating, but it's impossible to ever know for sure, right? What's going to be the catalyst or how long it's going to take. You know, UiPath could be flat for, you know, until fiscal 2027, which would start next year. Maybe until Q4 when they guide for next year's earnings. And that's totally fine with me. You know, I'm a long-term investor. The reason why I have such a big position in Path right now is because it outperforms all the other stocks in our spreadsheet over the 5 and 10 year time period. So I have made a short-term move, you know, selling a little bit of my lemonade into UiPath, but not because I'm trying to get rich quickly, because I'm trying to get rich slowly. And after lemonade tripled, UiPath now has, you know, double our expected 5-year returns. Even though, you know, UiPath still has, lemonade still has over a 30% annualized CAGR in our spreadsheet, which is insane. Like the fact that UiPath can have double our expected return in our base case over 5 years over a stock that has a 30% expected compound annual growth rate in our spreadsheet. That's wild. That's wild. So I know it's confused a lot of people. They're like, are you still bullish on Lemonade? Yes, of course. I'm still super bullish on Lemonade, but I'm more bullish now on UiPath. And it's not like Lemonade has done nothing but execute perfectly. They've done nothing but actually achieve everything that I thought they were going to achieve. So I know it's really hard for people to be like, wait, you know what? How come you own so much UiPath now when you were saying all that stuff about Lemonade? Don't you still believe it? Yes, I still believe it. I still believe it. One way that you could think about this is insurance is worth 8% of global GDP, the global economy. 8% of it goes to insurance companies. Now that's everything: health insurance, car insurance, life insurance, liability insurance, business insurance. We spend a lot of money as a species on insurance, protecting ourselves from bad things. We're very risk averse. So that's a huge market for Lemonade, right? Only a $6 billion company or something like that, to be trying to automate an $8 trillion market. But here's the thing. UiPath is going for the rest of the economy. UiPath is trying to automate not only, you know, the other 92% of the economy, but also all of Lemonade's competitors as well. So like 100% of the economy or 99% of the economy, everything that's not Lemonade, UiPath is trying to provide automation for. Now, there are a lot more competitors that are trying to do AI automation. I think that clouds the space a lot in a lot of people's minds. It makes them, you know, a little bit confused about, you know, who's going to win. Whereas, you know, Lemonade's a little bit simpler. They're competing against companies that are 50 to 150 years old, that are not really embracing AI that fast. And that lack of competition, I think is really comforting for a lot of people. I mean, it's comforting for me. However, I have done enough research now. You know, we're probably nearing 400 hours of research into UiPath, the UiPath's competitors, over the last 4 months, where I'm now at a point where the space is not confusing to me anymore. And I think it's very clear that UiPath should be viewed by the market as one of the main beneficiaries of AI automation, yet they're viewed as a company being disrupted, which when the market is looking at a stock completely backwards, that is when the opportunity is the highest. And they were looking at Lemonade completely backwards last year, but it's not $11 anymore. Okay. Lemonade is now, you know, $70. Now, like I said, it still has a forward expected return. I still have a forward expected return for it of 30% a year, but it was insane. Like you guys wouldn't believe what our chart said when it was 11, right? If we still have a 30% expected return, like Lemonade had almost triple the forward expected return of any other stock in our spreadsheet. And now UiPath has double the forward return of any stock in our spreadsheet because, UiPath is at 11, right? It hasn't run to 72 yet. The market hasn't started re-rating it at all yet. And that is what makes me really excited because I'm a contrarian investor. Now, I'm not just going to buy something that the market hates because the market hates it, but that's a reason to look into it because if you can bet against the market, this is actually a Peter Thiel quote, if you can bet against the market and be correct, that is how you make life-changing money. Now, I do this to, I think, a far more insane level than most people would ever dream, but that's because I put in more insane work than most people would ever dream of putting in as well. Like obsessively 8, 10, 12 hours a day, listening to interviews, running analysis, thinking about bear cases, listening to competitor product reviews, listening to competitor earnings calls. Like I obsess so that I can build the confidence level high enough so that I can make the moves that everyone else thinks are crazy. Now, does that mean I can't be wrong? Of course not. I could still be wrong. It's totally possible I could still be misseeing something, which is why I obsess 8, 10, 12 hours a day trying to figure out, okay, is there something I'm missing? Like, how come this seems so obvious to me and not obvious to the market? But once I figured out the reasons I think the market hates it, and I understand those, and I understand why those reasons are wrong, then, you can start to invest $10 million into a single stock. And still sleep like a baby. Now I have to admit, last night I did not sleep like a baby just because it's happening, today. So there's a lot of excitement. So I'm going to run through some numbers here because I want you guys to understand the current valuation metrics. And if you're not experienced with investing, and they don't make sense to you, I hope that it does not dissuade you. You do not need any education at all to download Robinhood and buy the stock. However, you should read One Up on Wall Street by Peter Lynch, and you should read it over and over again until you understand it all. And there's Philip Fisher and Warren Buffett. Like, read the great investors who actually beat the market. Don't watch CNBC. Don't read any college textbooks. They're going to teach you how to do average, how to do terribly. If you want to do average, like you probably learned how to do that in middle school, as Peter Lynch says. So read the greats, read how they thought about the market because they were the ones who actually did it well. And yes, there's probably still going to be some false things that they believe, but at least the false things that they believe did not stop them from outperforming the market. Whereas most of the false things that the average person believes do stop them from outperforming the market. Like one thing that gives me confidence to be all in, or nearly all in Path right now with just 1.5 million in Lemonade as well. But what gives me that confidence is hearing Warren Buffett say, well, diversification is stupid. And Peter Lynch say, if I could own only one, if there was only like one stock, I would be comfortable owning only one stock. Like hearing these great investors say that, it's really, really helpful because these guys are brilliant. So, read the best. But if you don't understand right now, that's okay. Asking AI about these numbers is a great way to learn more if you're curious. So historically, UiPath is a fast-growing robotic process automation company that builds deterministic processes to automate Fortune 500 company workflows, the largest companies in the world. And I believe their historical CAGR since going public is 40% a year is the average. So people are looking at a stock that, 3 quarters ago did 4% revenue growth and thinking, "Wait, this is a slow growing company. Why do you like it?" Not knowing that is actually the outlier, not the 40% that the highest I got them getting to in revenue growth is 30% going forward. And in my model, they don't even get to that for 4.5 more years. Next year, I'm only expecting 16% revenue growth in my model. And I think they might absolutely destroy that. And I still think it has double the returns of the next highest stock in our spreadsheet. So just know, okay, so we've gone from 4 to 5 to 13. Last quarter was 13%. Actually 14% revenue growth, 11% ARR growth, which is annual reoccurring revenue growth. So yeah, people are like, it's growing 14%, not realizing that, we're climbing out of an outlier bad period. Already using robotic process automation, they have been able to automate hundreds of millions of work hours. So now adding AI-powered agents into these workflows, and hopefully we'll have time to watch a Maestro demo here, but adding AI-powered agents into the workflows makes the process 10 times more useful by introducing human-level thought and reasoning within them. So essentially, in the past, and they already have 10,000 customers, they have hundreds of customers paying over $1 million a year for UiPath's robotic process automations. In the past, UiPath was pretty much automating with their hands tied behind their back. Their robots did not have brains. And now the robots are getting brains. And people are bearish on the stock. What? That doesn't make sense. They're getting 10 times more valuable. Their automations are going to be able to do far more without humans. And people are getting bearish on them? That doesn't make any sense. So adding AI-powered agents into these workflows makes the process 10 times more useful. It's at least twice as useful, probably, but I think it could be literally an order of magnitude more useful, which makes it 10 times more valuable, order of magnitude more valuable to current customers, and 10 times an order of magnitude more valuable to prospective customers, which is probably why Daniel Dines is saying that they have now more customer demand than they have ever seen. And I have that clip lined up, but we'll listen to it in a minute. Instead of only being able to help humans by doing the most repetitive and brain-dead tasks, putting AI agents within the workflow orchestration now allows full end-to-end automation of entire job roles. Okay, this is moving beyond, hey, companies are gonna, they can talk to ChatGPT and it can help them. Or, you copy paste something that you want to write into ChatGPT and it helps make your post better. This is fully autonomous end-to-end workflows that AI is able to do on businesses' current tech stacks. The current SaaS, the current software as a service that these customers are employing, they don't have to change that. UiPath adds on top and literally empowers AI with all the toolbox they have, the huge automation toolbox they have, allows AI to literally use your Google software, use your Salesforce software, use, access the data in your Snowflake, right? You don't have to change what software you're using. And that is what's so powerful about this is you can do full end-to-end workflows on your current software by orchestrating it all through UiPath Maestro. Despite the insane potential and rave customer reviews, Path currently only trades 11 times EV to look-through earnings. Let's break down what this means. So EV stands for enterprise value. It's the actual price that you're paying for the company when you buy the stock. In Path's situation, they have $1.3 billion in cash and cash equivalents. Some of that's in short-term investments, and no debt. Now they do have some liabilities, but they don't have debt. And if you do assets and take out all the liabilities, I think they have about 1.6 billion in shareholder equity, and 1.3 billion of that is in cash and cash equivalents. This makes their enterprise value lower than their current market cap. And as an example as to why, if you were buying a house that had $100,000 of cash sitting inside that you would own once you bought it, you would reasonably back that cash out of the price that you're paying for the home. So if you bought a house for $300,000 and you knew that there was $100,000 of cash, sitting on the table inside that was going to be included in the deal, then, you could reasonably say, okay, I'm buying this house for $200,000. That's what EV is trying to do. You're adding debt to the market cap, you're subtracting cash and equity. My look-through earnings number, so this is on the second half of EV to look-through earnings. My look-through earnings number applies my long-term expected profit margin on the trailing 12-month revenue. And guys, the reason I'm doing this is because when you're investing in a fast-growing company, a young, immature company like Lemonade or UiPath, like Lemonade, they're not going to have any profit, any gap profit probably until the end of next year or the beginning of 2027. So how do you know how expensive a stock is? Well, you have to know, okay, what amount of profit margin would they have on their revenue if they were a mature business? And then you can apply that mature business profit margin. So you have to understand what profit margins competitors have and how much more efficient Lemonade might be than them. And you can apply that long-term profit margin on today's revenue so that okay, so obviously right now they're reinvesting in product development, they're reinvesting in marketing, they're just investing all of the potential, cash flow that they could be claiming, they're reinvesting it into more growth. So you're not going to see it on the balance sheet today, but you can know this sort of business, how profitable it is likely to be in the future. So that's what I'm trying to do. I'm trying to remove all of the present noise so that I know, hey, if I was buying this company right now and I thought it was going to grow 0% forever, and they were actually managing the business to the highest profit margin, what would I be paying for it? So in this situation, I'm expecting very conservatively, as remember, they are automating entire job roles, which inevitably makes them more efficient. And Microsoft currently has this level of net profit margin with far lower gross margins. UiPath's gross margins are above 80%, whereas Microsoft's gross margins are around 65%. And has less automation than UiPath will have long-term, and probably Microsoft will also have long-term, a lot more automation. But I'm expecting that past long-term profit margin, net profit margin will be around 35%. And just so you know, this is almost double the long-term net profit margin I'm expecting for Lemonade. Why? Well, Lemonade, of all the premiums they collect, they're going to have to pay out probably around 65% minimum in losses, in claims, because as an insurance company, you collect money and then someone crashes their car. Well, you have to pay for a new car for them. So insurance companies, generally, sometimes claims can be 90, 80% of the premiums that they're collecting. For Lemonade, because they use AI, they're a lot more efficient. They're a lot better at pricing risk. Lemonade's in the mid 60s of a loss ratio. But guess what? UiPath doesn't have a loss ratio at all. So I think that Lemonade can get to like 20%, maybe 25% net profit margins, which would be twice or 3 times more profitable than current insurance companies today. UiPath has 80% plus gross margins and no loss ratio, right? They're not providing insurance for anyone. They're selling a software that once they've built it, they can just sell the new software to new companies for very little cost. Now they do have to help build it. They send forward deployed engineers to the company, help them orchestrate what the whole workflow is, help them plug in all the RPA bots and AI bots so that it can, and like correct it, give feedback to the AI so that the task can actually run with high efficiency and success and with governance and accountability and all that tied in. So it does take some engineer effort to go to these big companies at first, but then it's just usage money coming in with almost no cost to them after that. So I think 35% net margins is probably conservative, because then the other thing you have to keep in mind here is at Fusion this year, which was UiPath's big automation event that they did in Las Vegas, Daniel Dines said that he thinks they're going to be able to start growing because now they're using Maestro internally. He thinks they're going to be able to start growing without increasing the headcount that they have. So I'm looking forward to them say that again in the earnings call. I think analysts would love to hear that. It's such a crazy thing. Analysts might not even believe it if Daniel Dines says that. But because of this, 50% profit margin, something like this, it's not crazy. It sounds crazy, but it's not crazy. So my base case is 35. So if you apply a 35% net profit margin to trailing 12-month revenue, the EV to look-through earnings is 11 times. So you're paying 11 times look-through earnings for UiPath, which means, let's just for easy math do 10. If you're buying a company for 10 times earnings that has 0% revenue growth forever, that's not a bad deal, because that means that you're getting a 10% return as an owner per year, which it can be paid to you in stock buybacks, which, UiPath is doing a ton of right now, literally like $1 billion of stock buybacks recently. It's only a $7 billion company and they've bought back almost $1 billion of shares, which they destroy. And that increases all current owners' ownership. Now, they do pay out a lot of stock-based compensation to employees, which I actually like a lot because it aligns incentives. So the employees are owners too, just like me. Daniel Dines, by the way, is a 20% owner of UiPath. Huge. Like that's what Elon wants to be of Tesla and can get to if he achieves his pay package. Daniel Dines already owns like around 20% of UiPath stock. So he is a huge owner. So that aligns incentives as well. But a company that you buy for 10 times earnings, that means it takes 10 years of earnings before you fully make back your investment, which means you're getting a 10% annual yield on that investment. And after you make back all your money, you still own the stock. And now you could buy another one, that has a 10% yield. And just so you know, government bonds are like 3 to 5%, probably not even 5% anymore, 4.7, and falling rapidly as quantitative easing stops from the Federal Reserve and interest rates lower. Your risk-free rate of return, which isn't really risk-free because the government is very poorly managed, but people view it as risk-free. Your risk-free rate of return is 3-4%. So buying a 0% revenue growth company at 10 times earnings destroys what you'll get buying government bonds or even company bonds. So it's an undervalued, it's like the S&P 500 is trading like 20 plus times earnings. So UiPath, its look-through earnings is half of what the S&P 500's look-through earnings is. Which is crazy for a company that, you know, could put up 30, 40% revenue growth numbers, 50%, 60% in a bull case. Like, that's wild that you can buy it for 10 times earnings. It doesn't make any sense. The market sometimes is insanely inefficient. So that is why I feel so confident, because even in a scenario where the rails fall off, everything about my base case is completely wrong, and the bear case happens, I still out-earn the margin interest rate that I'm paying over the next decade. That's crazy. In a bear case where you can still easily get 15% annualized returns. And then in a bull case, you can get, you know, way higher than that. And the company in my base case, which I have, I could show you guys, should have actually already had that ready. I could show you guys the spreadsheet. I'm pretty sure it's like 6-7 times return I'm expecting in 5 years for UiPath. And honestly, if the bull case happens, then the base case is thrown out the window. We could get a 10x in like a year, which is why I think Path could be the best performing stock in the stock market next year. So hopefully you can understand my reasoning there. Okay, so when I apply a 35% profit margin on trailing 12-month revenue, the stock trades 11 times this value. For context, the S&P 500, the 500 biggest publicly traded companies in the US, trade almost 30x. Now, we have had a little bit of a pullback, so it's not quite that high now. If you look at the Mag 7, it's almost still that high. The value of trailing 12-month revenue. So almost 1/3 the valuation of the Mag 7 and growing faster than the Mag 7 already, by the way. Like, we don't even need any growth acceleration this next quarter. So that means that, you know, UiPath could triple, and then it would be trading kind of in line with Mag 7 stocks. Or if you want to think about it compared to Palantir, because Palantir is very expensive right now, UiPath could 10x. Okay, so it could go up in value by 1,000%, and it would still be trading at a 60% discount to Palantir, just to put things into perspective. So you're buying a company at around 10 times earnings that's stable. So, if you're buying a company that's 10 times earnings, that's stable, but has no growth, you would earn a 10% return. Okay, I've already gone through all of that. So yeah, just trading like a company that has no growth. A company like Palantir, who the market already understands is automating jobs and has a lot of growth ahead, trades 300 times next year's earnings. Path stock would need to increase by 1,500% to similarly trade 300 times next year's expected earnings. So with 20 million in Path, which I hope to own as close or prior to UiPath's next earnings call on December 3rd as I can, I've only gotten, I think, to about a little under 13 million, I think is what I'm at right now. So I will continue buying after earnings, especially if they're good. I still want to almost double my Path position. I would like to get to 1.5 million shares, maybe 2 million shares. Right now I'm a little over 900,000 shares. The company increasing revenue by 5x over the next 5 years and trading 100 times look-through earnings in 5 years would make me a billionaire, which is crazy to think about. When I started investing in 2019, I had $20,000 to my name that it took me 7 years to save. And now 6 years later, I literally think I have found a path to billionaire, which is crazy.